Okay, folks, we'll go ahead and get started. I'm Jim Rhodes, your presenter for today. I am the founder of the Octane Group, and many of you who are in attendance have found us by way of LinkedIn or Facebook, so you may know from following the Octane Group that I'm a specialist in the buy here, pay here space. Our firm is 100% buy here, pay here. While I do have some experience in the new car arena, I often tell people I've forgotten most everything I knew about that time in the new car business. That was more than 20 years ago, and I just spent a short time in sales and sales management before stepping into buy here, pay here. So while I do have familiarity with that part of the car business, my career has been almost entirely buy here, pay here, and so that's the clients that we serve at the Octane Group. Um, as a firm, what we do is training and education. We specialize in launch packages, helping dealers get started in the buy here, pay here space, and so that's obviously what today's webinar is about: teaching those of you who are contemplating buy here, pay here, what it's going to take to get in the business and some things to be aware of, as you move toward that space. The other thing that we specialize in at the Octane Group is analytics. So we do weekly and monthly services for our clients, and so that's part of how we, learn. I've recently calculated that I've done weekly numbers for some dealer somewhere for over 1,000 weeks in my career. So we're used to seeing numbers from the buy here, pay here industry, at some level, and have been monitoring that for some time. That's helped us to identify ways to um, better serve the industry. So now let's talk about quickly my management experience. My early career was in sporting goods, and I owned businesses before I stepped in the car business. Short time in the franchise world, as I mentioned, and then I was introduced to the buy here, pay here business. I was asked to open a buy here, pay here dealership in 1997. So I was with a group that had Dodge and Chrysler stores, and I helped them open their sixth buy here, pay here store. And I have been in the buy here, pay here business ever since. I started doing consulting exclusively in 2000. So for the last 20 years, between the work I did for a company in Florida and the work I've done independently since, I've now been in 26 states professionally. So, that's what helps me to help you understand the business of buy here, pay here, and what to anticipate as you contemplate the idea of getting in the buy here, pay here business. Now, I always start with what the buy here, pay here business is not. And, there's such a misperception, it seems, about buy here, pay here. And most of us have, talked to people at a car auction or whatever, and you'll hear some that are being very successful, and you'll hear others that say, I did it, been there, done that, won't ever do it again. When we do it wrong, it tends to not work out well. So let's make sure we understand what the buy here, pay here business is not. It's not the car business. It's not the same as what some of you would know from the franchise business or even the independent retail business. And that's not to say that those of you that are in the car business won't bring some of your skills and your knowledge from the car business in to the buy here, pay here segment. It's just that there are more differences than similarities. And it just means that we sometimes, if we bring a car approach to the buy here, pay here business, it can sometimes not go well. I'm working with a client now who's having difficulty making that paradigm shift, and so it's just it's an example of why it's so much different than the traditional car business. We have to understand it's not a sales business. It's not about rapid growth and creating big profits. In reality, in the business of buy here, pay here, we're not focused so much on growth profit. We create a lot of gross profit, and it can be intoxicating to some. But at the end of the day, what we're doing is agreeing to finance customers with poor credit. We're often doing it without a very large down payment, and as a result, why would we be surprised that we're creating sales? And so I tend to not, pat myself on the back or pat my clients on the back when they're producing sales. it's really, in this business, you're going to find it's more about managing the cash flow. It's about managing capital, and it's not so much about selling cars and creating gross profit. The fact is, we create gross profit, we're creating income tax, and so we need to be careful in the way that we produce sales in this business. I often say that, especially car people, and I love them, they're my clients, but the reality is of the urgency that comes from the buy here, pay here, or from the car business rather. If you bring that sort of urgency and aggressiveness into buy here, pay here, I often say you can race right off a cliff in this business, just because if you focus on growth and grow, you can outrun your capital, and you can definitely you know create a problem in that particular business. So when I say seasoned car people, they often struggle to adapt in this paradigm shift because they're used to seeing credit through a different lens. They're used to disqualifying customers or determining who wouldn't qualify, and they're just used to looking at credit differently. I can tell you, as a buy here, pay here specialist, when I sit and look at a credit report as a buy here, pay here manager or training managers, I'm telling them entirely different things. They're learning to look at credit reports in an entirely different way than what we're used to doing, over on the retail or the franchise side. Car people tend to overlook the fundamental differences, and that can be catastrophic. So there are just a lot of painful lessons to learn if we don't come to understand those fundamental differences. The they often can't shed that urgency I talked about. Obviously, that sell, and follow up, and all those things that we know from the new car side or used car industry. Those things, if they stay embedded when we move into buy here, pay here, that really cause problems. And folks who are from the car industry tend to be too gross profit minded. And as I said, this business is not really about profit. We should expect that we're going to have profit. We're, at the end of the day, we're financing a customer with poor credit who's frankly disadvantaged. They're not in a strong negotiating position, so we're going to create gross profit. We're going to be able to hold the margin, set prices and interest rates where we need to, and so profit won't be the challenge for that. So number two, the other thing to think about is what self-financing or buy here, pay here is really all about. We know that successful buy here, pay here dealers come to understand that they're helping folks. I believe that having compassion and empathy for customers who are in that situation, it matters. And I've certainly met dealers. We've heard of dealers that, don't bring that approach. They're all about just creating sales and creating big portfolios. And so I'm going to sell those portfolios, and that's fine. That's just not the way I teach that you approach this business. And my clients are typically those that are in the business for the long haul. And that means that they need to be prepared to cooperate with customers and be flexible and work through situations. That's just the nature of this business. And that means that, things like hiring employees that share that compassion and understanding and empathy for others is going to be important. And, I know that people who aren't from this business would hear that and say, gosh, that's just a bleeding heart. You're going to be so soft and so flexible that people are going to run right over you. That's not the case at all. We just know that we have to bring that sort of compassion into this business. And then, we're able to hold customers accountable, but certainly it starts from a place of compassion and empathy. This business is more about cash flow and cash management. It's capital management, much more so than it is volume and gross profit. So, quick story about a Chevy dealer, long established franchise dealer in what I'll call a John Deere town, was shared with me that they pay their buy here, pay here lot $10,000 a month in interest only. So let me say that again. They pay their buy here, pay here lot $10,000 a month in interest on money that the buy here, pay here dealership has supplied to their franchise operation. So we don't know the interest rate. We don't know how many dollars that is, but it's pretty easy for us to figure out that that's a good amount of money that the buy here, pay here lot has created in terms of positive cash, is able to supply to the franchise operation. So, that alone is reason enough for any franchise dealer to contemplate the buy here, pay here business. And, we could do a whole separate webinar on why it makes sense for franchise dealers to be in the buy here, pay here space. But for today, we're just talking about why it makes sense for anybody to be in this space. And what we know that buy here, pay here is all about too is collections and effective underwriting. That again, profit is never going to be our challenge. We're going to have markup. We're going to have high interest rates to mitigate risk. It's just part of it. And we know that the right pay plans are really important. They're difficult to create because you have so many moving parts, so to speak. You have the collections component, and you want the long range performance to be a factor in any kind of a pay plan. So that can be challenging, but it is important. And we just can't use, conventional car pay plans for buy here, pay here. It's just a much different animal. So keys to managing collections. My top tips for effective collections. First, you got to commit to an approach. You've got to be make sure from the top down that we're adopting an approach and sticking with it, and that everything that we do, is tied back to that approach. And then we have to accept that we're playing a long game in buy here, pay here collections. We have battles and we have a war that we're trying to win on the collection side, if you want to call it that. But we have to make sure that we are able to weather the storm and be flexible. And contracts are going to have hiccups, and we have to be able to take a long game approach into collections. That's why I favor collection efficiency. We don't have time to go too deep into the definition of that today, but I track collection efficiency for clients, and we definitely favor that over delinquency because it is better for morale, and it's better for longevity. And I would always argue that it rewards collectors for doing what I would ask them to do, which is getting dollars in the bank, even if they come a little late. So, again, this is why we tend to de-emphasize delinquency, make a priority of collection efficiency. And so it's important to understand the difference in those and to be able to create pay plans that reward collectors, and that lets them stay around. When we hire and train a good collector, that's not a fun job for a lot of people. There's a segment of our population that are cut out for that kind of work. And when we find them and we get them trained, we want them to stay. So that means creating a pay plan and rewarding them for doing the job that we want them to do. And in my approach, that's about getting dollars in the bank, like I said, even if they come a little bit late. We have to recognize the importance of accountability in collections. That goes both ways. That's internal accountability, how to hold collectors accountable to doing the job that we expect them to do, but also it's about how our approach and our policies hold customers accountable. And people who work with me, my clients, hear me say, and when I owned a dealership for 7 years myself, my management team heard me say the words over and over again about being fair and consistent. We need to always be fair with every customer, and we need to be consistent in the way we handle collections and all account matters. So that's why accountability becomes so important. We stick to what we do, and we have to make sure that we hold people accountable and hold customers accountable to the same standard, across the board. And we obviously, in doing that, we avoid any kind of appearance of discrimination. We just want to be consistent and do the same, handle every customer exactly the same. Now, number 4, choosing a buy here, pay here business model. Now, I'm going to have to jump out of this PowerPoint and show you a spreadsheet, because this is where we really want to spend our time today, because I can't emphasize enough the importance of learning before you step into buy here, pay here. You have to really dig into this matter of cash flow versus equity. And I talk to a lot of dealers who kind of, they just open up and they're going to just sell some cars, and they want to sell 30 cars a month. And if they get a chance to sell 40, they want to do that. And so it's about kind of reaching the place where you begin to understand that, gosh, we can create sales. We just need to figure out what are the right kind of sales. So let's look at this. You're seeing the screen there, and you might confirm on the chat menu there that we've got that you're able to see the screen and follow the screen with me, because this is such an important part of what you have to know as you step into the buy here, pay here business. So I built this for clients in helping them to make the judgment. I often say that when I'm working with a client on the buy here, pay here side, when we're introducing them to the business, the conversations that I have to have with them early on are not unlike the conversations that you and I would have with a financial planner. If we sat with a financial planner and, they would be asking us questions about children and, what's our strategy about retirement. And, there's a lot of things to plan because in buy here, pay here, we have the opportunity to create nearly any kind of business that we want to create. But in order for me as a consultant to advise a dealer on which model makes sense for them, I have to understand what's the outcome we're looking for and what's the timeline. Because some would create lots of equity. You could create lots of contracts and keep pumping in cash, and you could build equity, and delay the day that you got cash positive. And what I ask dealers to think about is we really need to understand the impact of being cash positive, the value of that, at least on a per location basis. So let's go through that and let's talk about how would I make that judgment? Well, really, when we talk about business model, first and foremost, we're talking about cost of car. Lots of other factors to consider, but if we look just at the kind of car we're going to carry, and for simplicity's sake, I've laid these out side by side. Let's look at model number 1, and these fields in yellow I can change out. But what we've done is we've just chosen a inexpensive car just to show the difference. Buying the car for $3,500 with reconditioning, a selling price of $79.95. And by the way, I always meet with some skepticism on low ACV models. It's out there. It's hard work, but it can be done. And so, yeah, I've seen it done, and it's still happening. It's difficult. Car prices are up, yes, but this can still be done. Now, again, $3,500 cost, $79.95 selling price. That means a gross profit of $44.95. It means a cash and deal. For those of you new to the business, that's just our cost up here minus the down payment from the customer, which we'll get to down here below. And that's our cash and deal, or our exposure at the time of delivery. Now that translates to 128% rate of return, the gross profit divided by the cost. And it's important to kind of notice those numbers in green as we compare the other models. Gross to cash and deal ratio is a number that I like to track for clients because that to me is more telling. What we own the car for is one thing, but our profit relative to our actual exposure to me is the more telling number. And you can see that in this case, it's 155% after we factor in the down payment. Now, if you look down, go on down and look at the financing, then let's say that this customer is $600 down, $85 a week. That is equivalent to about $368 a month. Now, the weeks to break out, in other words, we would have to collect $85 a week for 34 weeks to break out of our cost. So again, right away, we see how this business is different than the retail business. You're not used to thinking this way in the retail business. We have to think about how long is our exposure period. This is how we mitigate risk and determine how long before our cash recoups what we've invested, and so we can get out of our risk period. Now, I've got sales tax and some other add-ons put in there so that we can arrive at an amount financed. And so that number down here is $8,300. We've got a term in months of 28 months, and estimated finance charges are there, estimated total payments. That gives me a potential profit with finance charge, and so on. Now, what I really need to get to, though, is I have this many months of profit on that particular transaction. And now I use the example down here. You can see on row 40 that I've used $500,000 and said, okay, I'm going to take $500,000 and invest it in model number 1 here, deal structure number 1. Well, if I do that at that cost of contract, and again, there's overhead to think about, I recognize that, but what we're just in the simplest form, we're saying if I had $500,000 to put in contracts, this would translate to 172 contracts. So the potential profit created from that capital is 1.1. The receivables created from that is 1.4. But the most important part to me is this right down here on row 43, because this is where we, again, have to think differently in buy here, pay here versus the retail business. What this says is that if I invested $500,000 at that particular cost and that down payment would translate to 172 contracts. 172 contracts times $85 a week translates to about $63,000 a month of cash flow. So that's important. Now let's go over and look at model number 2 or deal structure number 2. Let's just do the same thing. Now, if I've got $6,500 cost instead, probably can't do 128% rate of return. We can look. Where would I have to price that car? Let's do $14,995. That puts me more like that. So I don't, you can see right away without being in the buy here, pay here business, even though the customer is really focused on different things, the reality is we probably aren't going to price $14,995 a car that we own for $6,500. If we do business, probably going to be pretty low. So let's go back to where we were and just go. This is the beauty of having this thing set up this way. We can just modify it as we go, and I can just, we can work in whatever numbers you like to see. But now we've got 100% rate of return. So not quite as much profit from our cost. And now if we look at the gross to cash and deal ratio, again, I'm giving credit for this customer having more down payment. Why? It's a newer car, apparently. I'm putting more cash at risk. So I'm putting more car at risk, I should say. So I'm going to ask for more cash down payment. And I've also allowed for even a little higher payment from this customer. Again, assuming this is a better qualified customer, more down payment, maybe more income. So I'm giving the customer benefit of having paid a little bit more. So instead of $368 a month, this customer is paying equivalent to $455 a month. It'd be interesting to go back and look at this and keep those payments the same, because often they are with my clients. But now you've got 47 weeks till you break out. Okay, we see that. But now we need to jump to this information at the bottom. Now that same $500,000 translates into 100 contracts, translates into nearly the same profit from the capital, because we've got more markup in dollars per contract, and we create 2.2 in receivables. So if we just focus on those two alone, you can see that this is kind of an equity slanted model. It's going to create more receivables from the same amount of cash that we've invested, the same $500,000. But from a cash flow standpoint, you can see that it only produces, and even though I'm allowed for a higher payment, it only produces $45,000 a month in cash. We can go on out and do a higher ACV model, and the illustration, kind of slants to less about cash flow and more about equity, because this one over here only produces 55 contracts. We don't have time to go through all of the numbers above, but bottom line is, you see what I'm trying to illustrate there is that as we go up the ACV scale, we can create a lot of equity and a lot of receivables, but we don't produce nearly as much cash on that same $500,000. So again, we all understand that overhead's a big factor here, but that's part of what we need to make sure we understand. Now, bear with me as I get back to our PowerPoint presentation here. So again, this is where I have to know specifically, what would you like to achieve with buy here, pay here? What are the timelines? What cash do we have available to invest? How long can we operate, with overhead before we need to get cash positive? Those are things we would have to decide. And those are not things we have to talk about in the independent world or the franchise world. So let's jump over and talk about capital requirements. So number 5 of the things you need to know before you get into buy here, pay here business is that we need to be able to forecast our capital requirements. So in order to do that, get this other sheet loaded so I can take you through it. This is my own cash flow forecasting tool. I built this thing in 2005 and continue to enhance it over time. I built it because I couldn't find anything in the industry that would do what this does, which gives me the ability to change the volume year over year and be able to see the impact of reinvesting by reinvesting in growth. So that's what this tool does. But for our purposes here today, I've got it loaded up with a really static volume, static selling price. And again, I can change these to, whatever we might need. And we won't have time today to go through the entire modeling, but what I wanted you to be able to see was how we go about helping clients make a judgment as to how much capital they're going to need. This thing is pretty complex. It rolls in the impact of a related finance company and the discounts discounting notes and how that affects our tax because that affects our cash. So the numbers you're seeing over here are post-tax and would have a related finance company in place, probably using a 30% discount. But what I really wanted you to be able to see is, well, we could change this volume and see the impact. If I were to move this volume to 25 a month, then you can see over here that shows how much that moves our total cash required. But let's just keep it simple for today and show you that if we keep our volume static, it tells us, okay, we're going to need about that much cash in the first year. So this is our total cash. We currently get cash positive right at the end of 12 months, which, by the way, that's traditionally what we see is dealers get cash positive at about the 12 to 15 month mark. It's pretty difficult. Now, so in year two, we've got a little bit of positive cash. Year three, we've got quite a bit more positive cash. We've now effectively recovered cash that we invested. So you can see in this simple illustration that that's why we don't see more people in buy here, pay here, is because even at a volume of 20 a month, and we've got some upfront costs loaded in there, initial inventory, we got some overhead loaded in there. This is just one I was working with on a client recently, but you can see that we've got to have enough cash to be able to get over the hump and get cash positive. Once we do, then life is simpler, even rosy, but we have to be able to create those contracts. One other thing I would point out down here in green, this is among the ways that we have to go through a paradigm shift when we step out of franchise and independent is, I've got in here that this customer set up I've got this modeled out at a payment of $376 a month. And that tells us we would need 33 customers paying $376 a month in order for our overhead to be covered. We would now have enough cash flow coming in from customers to cover our overhead. We'd need another 215 customers paying to cover the cost of replacing these 20 cars a month. And so that brings a total of 248. When I factor in the down payments, I need 206. Okay, so that just means this dealership would need to climb to 206 active accounts, performing, paying customers in order to get cash positive. So another way to think about that is if you had a line of credit, you would draw up to about that 579 mark, and then you would have enough accounts on the books that you would be generating positive cash. You would start to pay down your line of credit. So again, just a really simple illustration. I say simple. There's a lot of complexities behind the scenes on these calculations, but you can see we can do startup costs. We can do our overhead per month. Here's where the portfolio gets constructed. And there's just a lot of things going on back there that help us drive these numbers. But this is part of how we have to arrive at, cash flow. So again, this is, it's a big thing to do to be able to forecast capital needs. And so that's often where we start with our clients is to sit down and do projections and help them anticipate capital that would be required for them to execute a certain model. So that's an important process. So again, that's number 5 is learning how to forecast capital needs. Now, capital sources, ways to fund that. I mean, most of you know how that would work. We'd have ability to fund it obviously through any of our personal funds or access to personal credit. Friends and family, which, if I think of them as investors, you might use a private placement memorandum to construct an offering and bring in friends and family if you want to do something that formal. Obviously, when you're raising money, if it's very intimate, then you don't have to worry about securities things in the same way. But obviously, when we're bringing out in outside parties, we really need to make sure we've crossed our T's from a regulatory standpoint and that we're bringing investors in the right way. You can also, go to lenders. But my experience with community lenders is unless you're somebody who's got a long history and you've got maybe some real estate that you can pledge as collateral or some of those kind of things, lenders just don't love the buy here, pay here business. We're talking about a local community bank. Most of them have been burned by it. You're financing customers that they wouldn't finance. So they're just not going to be a good source for funding, typically in the early stage of a buy here, pay here business. Now, once you've been 2 years in business and you've got some history of cash flow and some financials, then your ability to go either to your local lender or some of the national lenders then your ability to get funding that way, is better. But it's not a good source, um, for a lot of the dealers that I launch. Now, so you can also go to hard money providers, whether they're payment streaming solutions, and we don't have time to get deep enough into that, but there are providers out there who will advance on a contract. So it's typically very expensive money, almost prohibitive, but it can be a solution. So be aware that there are ways out there to access funding. You can sell notes to bulk buyers, and there are plenty out there. I'm always amazed at how many people approach me about buying paper from my clients, but I'm just not in that business. I'm in the business of teaching dealers how to create and manage their own portfolios. And I often remind my clients there's a reason that so many people approach me about buying your paper. It's because it's profitable. And so we don't want to see you give up that profit. We'd rather see you manage that portfolio and keep that profit yourself and enjoy that cash flow and income. So I don't often work with bulk buyers, but just know that can be a way, a means to an end. If you have enough capital to do 60 contracts and you have the ability to produce 100, we could always fund 60 and sell the other 40 contracts off to a bulk buyer. So that can be part of a strategy, but that's not true buy here, pay here. You're not keeping all the paper in house. And my definition of buy here, pay here is, we're going to originate the paper ourselves. We're going to underwrite, make the approval decision. We're going to service the paper and service the customers and support the customers. So that's true buy here, pay here in my estimation. Now, credit acceptance, you can find them online. That's somebody who, they'll buy paper. They're pretty aggressive buyer and subprime paper, so you can send the paper their way. But you're going to get a pittance. You're going to get a small amount of money out of the deal at the time that it's delivered, and then but you wouldn't be going negative on cash. You'd be going slightly positive, and you have a chance to participate if the portfolio does well. You have a chance to participate down the line. But again, you're deferring most of your income over to them, rather than keeping it in your pocket. So it's not what I teach. It's not what we'd recommend. Number 7. Identifying the tools and technology for buy here, pay here. There are plenty. I can tell you there's lots of great technology out there versus when I first got into business. Software is better. The GPS solution obviously is something virtually all of my clients are doing GPS on every car that they finance. There are great marketing solutions, whether it's digital, social media. There's lots of ways to, a lot of people that are providing great tools for people in the buy here, pay here space. Reinsurance is another one everybody needs to know about. It doesn't always make sense for everybody right out of the gate, but reinsurance can be a really important tool. And I've had a lot of clients have a lot of success by creating their own reinsurance program through a third party. But reinsurance is an important tool and be a good solution to support clients at the same time. Financials and accounting, there are good providers out there that know the industry well, so we can help introduce to those. But it's important to know that those exist, and then there are tons of solutions now for collections and payment processing, even the ability to collect by text message. So it's important to know that technology is definitely moving in our favor in that way. So let's talk about sourcing the right inventory. This is such a huge subject and certainly hard to cover in this format, but I just want to share that, when I say the right inventory, that means the right vehicles for your particular business plan. So when I'm training new dealers and managers to buy cars, I'm typically teaching them to buy what I call buying a price. They're going to the auction looking for cars in a certain price range, and they're trying to buy the best cars they can in that price range. Why? Because of all the mathematics I showed you earlier, with those spreadsheets. We have to stay disciplined to our business model because deviating from that can be very costly. So we have to stick to our business plan, which means buying cars in a certain price range and not necessarily chasing after, four-wheel drive F-150s or, certain sports cars. It's more about sticking to a price model and offering our customers the best car we can. Now, buy here, pay here offers, as opposed to independent retail and franchise, buy here, pay here offers a much higher turn. Why? Because it's less about offering the customer a wide selection it's more about, meeting their transportation needs. It means we can get by on a smaller inventory and turn it over faster. Affordable repairs after sale are very important. So what we choose to buy, obviously we can expect that if we buy Mercedes and finance that, if customer has repairs after the sale, then it's going to be much more expensive to make that repair versus a Ford car. So just we have to think ahead to how to support the customer, because if we're having a 3-year relationship with the customer, odds are that car is going to require repair during that 3-year window. And so we have to be prepared to manage that. And keeping those costs down is important for the customer, which makes it important for us. Now, more customers are shopping financing rather than cars, which means that's, again, goes back to it's less about selection, more about having a finance program they respond to. Then once you do that, then we're able to attract them with financing and typically meet their transportation needs with something in our inventory. So most buy here, pay here customers are focused on 3 things. And again, for today, we're focused on the rule rather than the exception. Most buy here, pay here customers are looking for how much down payment do I need? What is it going to take to get approved? And then lastly, how much would my payments be? They're mostly focused on what is it going to take to get in it. So that's just a whole different approach and environment than what you'd find in a typical retail store. You just got people shopping financing first, and so we have to position ourselves to be able to serve that. Number 9, how to know that our buy here, pay here operation is working. So for me, that's partly about sales, making sure our margins and our ratios are favorable, that our terms are in line with our business plan, contract length, etc., and that we're doing enough volume to achieve that business plan level that I talked about to get cash positive. But mostly we're looking at collections. We're making sure that our portfolio is performing as expected. We have to know how to know that that's working. And so keeping an eye on what I call conversion rates. I think others in the industry may give that a different name, but it's really the rate at which your portfolio converts into cash. So we track those things. We track collection efficiency. Recency is another one. Static pooling is helpful, but it's more of a long range indicator. And we really, in buy here, pay here, we really need to find more near-term indicators so we can know how our performance is now and be able to take corrective action where needed. So, those are things that we have to do, is watch those key performance indicators, and it's really about making sure the portfolio is producing as expected, and that means monitoring the right things to do that. So number 10 is before you start a buy here, pay here dealership, you need to know who to turn to for coaching. And of course, we'd love for you to call us at the Octane Group. That's what we do is buy here, pay here. You can tell that's our expertise. And if you're going to step into the buy here, pay here business, I always think about the client that I helped start in Utah many years ago told me. So we felt like if Tiger Woods, and this was at the peak of Tiger Woods' golf career, if Tiger Woods needs a coach, then so do we. And so it's really about just understanding that a good coach is supposed to be able to help you from making the costly mistakes. We're to help you mitigate risk and avoid the hazards, if you will. And so that's why we'd love to have a chance to talk to you. I've got my phone number listed there. Any of you are welcome to call or text me directly, and be happy to help. And with that, I will attempt to open up the microphones for any questions. I don't see any questions in the chat bar yet.
Go for it. We'll like yesterday.
One moment. So I see, Zach, that you've raised your hand. You've got a question. Let me open your microphone if you're still with us.
Once that's done, then we'll.
Hi, Jim.
Go ahead.
And then
Are you there, Zach?
reading the.
Yes, sir. How are you doing?
I'm great. Go ahead with your
wonderful presentation.
Thank you.
Enjoyed looking at it. I was just wondering if the 30% repo rate that we hear about, is that like a realistic standard, or is it more towards going into does it fluctuate to 40, 42?
Yeah. So I'm always very
general.
careful. Yeah, I understand the question already. Like I'm always very careful when I answer that because there's so many different ways to
Right,
measure,
right.
right? So I think when you hear that, typically people are talking about that static pooling ratio that that I mentioned, and that just means if you tracked your entire portfolio all the way to maturity, what percentage of the contracts would make it to maturity. So saying that another way, 70% would reach maturity and 30% would default at some level, and that's absolutely within the realm of possibilities. I just choose to look at repo rates in a much different way. But to answer your question, 30% repo rate is definitely, or said another way, your 30% charge off to bad debt ratio is certainly within the realm of reason.
Okay, and then recently, with lease here, pay here, do you guys have any? I mean, are you in that space for training and stuff, or sticking to the buy here, pay here side? There's a lot less capital markets for that model, from
Right.
what I understand right now.
Well, you're
But there
saying
was some
there's
traction.
less capital for leasing, right?
Correct.
Yeah, that's my understanding too. That's always been the case since I've been around. There's just fewer buyers looking to lend, or people looking to lend against it, and fewer buyers looking to buy that kind of portfolio. The secondary market is different for leasing. I am very familiar with leasing. I didn't touch on it here today because it's a pretty big subject, but yeah, leasing can be a real win. Especially, I tend to favor leasing in areas where sales tax rates are high. Otherwise, all the other factors you can overcome other ways by doing a related finance company, and then you have a retail installment contract that is more marketable. So, but yeah, I'm very familiar with leasing. Lease your pay here. To me, they're both cash flow, right? We're both in both scenarios. We're both financing a car, and we're collecting payments, and so it's cash flow can be similar. It's just a question of how we capitalize it and how we.
Right, and so for Texas, the way the sales tax is right now, I guess there's really not much incentive to actually move over to the
I
lease year period.
Yeah, we could cover that in some depth, and you're welcome to
Okay.
call me, and I can take you through that. But the reality is, yeah, Texas was definitely a state where leasing is going to be hard to justify because you've got the ability to do that seller finance tax program in Texas, and the other advantages of leasing are going to be offset by other things. So yeah, it's going to be hard to justify leasing, in my estimation, in Texas. Yeah, let's talk about that directly. Feel free to give me a call whenever you got
I
time.
will. I'll definitely call you, Jim. Thank you so
Please,
much.
yeah, you bet, of course. And so if we have anybody else want to raise their hand, got any questions, I'm happy to cover those. I appreciate you others joining in. I don't see any other questions. Chantel, happy to have you involved. I'm glad you were able to participate. I look forward to catching up with you. Just give me a shout. I hope you found the session useful. I'll probably have a better understand what Jim does day in and day out. So yeah, by all means, reach out if you and I need to catch up anyway. So glad you made it in. David, appreciate you. Oh, Chantel does have a question. Let me open your microphone there. Hang on. Okay, you
No,
should. Are you with me?
I was just gonna say hi and let everybody, I'm over at Agora now, so we've got some options also if some dealers are having some problems with cash flows.
Of course. Yep. And I'm familiar with the services that Agora is offering these days. So yeah, I'm happy to
Yeah, we need to catch
introduce.
up for
Yep,
sure.
I'm happy to introduce folks to Agora, and now that I know that you're there, then obviously I'll reach out to you as well. So yeah, thanks for
Awesome.
sitting in. Okay, I'm going to mute your microphone. We'll catch up again later. So, any other questions? If anybody's got questions, by all means, I'm happy to take time here. Zach, you had another question?
Did you say if
Yeah,
I had another question?
Yeah, I was asking you. I thought it looked like you'd open your microphone.
I have way too many questions.
Well, that's fine. You and I can cover those one-on-one. It sounds like you're contemplating getting in the business, so I'm happy to spend time with you. We'll just
yeah, I'm a wholesaler, so I supply cars to buy here, pay here dealers.
Oh yeah, Okay.
Consistently. So I'm familiar with some parts of it, and then the other
Sure.
parts, were kind of scary.
Yeah.
So,
No,
but
I got you.
so I'm getting there. So I know about Agora, and I was looking into that too. And there's a couple of other ones. So we'll talk about it after.
Yeah. I think it's interesting that you used the word scary. So I know a lot of people feel that way about the business. And so, yeah, that's often my job to help mitigate risk and take away some of those fears and
But I
concerns.
would like to see if maybe the question might help somebody else on the line. I don't know. What's the like the slow and steady growth example you may have where what was like the least dollar amount somebody had to venture out into, like buy here, pay here, doing like maybe 5 sales a month or something like that, just slowing their
Sure.
sales down so they can actually survive?
Yeah, no, that's fine. I think for me that number, we just actually ran through some models with a client not long ago, and I basically just told them that if you're going to do less than about 15 sales a month, I don't know that I'd be recommending buy here, pay here. It's just
Gotcha.
there's enough risk associated with that, and the manpower required to do that right is, to me, 15 a month is kind of the measuring stick. I think you want to be at a volume of 15 and above to really justify it. And I can take you through it. If we want to do some cash flow modeling with you, I can take you through that, and you'll see why I might pick that number.
Yeah, I can see why you picked it.
Sure, sure.
But I'll call you.
Okay.
And then we'll talk about it later
Very
on.
good. Absolutely. Thanks
Appreciate
again
your
for
time,
joining.
sir.
You bet. Talk soon.
Thank you. Bye bye.